Good day, investors. Today, we are going to look at all the companies in the oil and gas sector we've so far looked at. Before we jump into the rankings, here's a full list of companies we looked at. I analyzed 16 oil and gas names, and you can find the deep dive videos for each one on my channel. So most of these companies are non-US, aside from Chevron, mainly because I'm looking for value, and the US names tend to trade at a premium, so you will notice a large number, let's say, of Canadian names. That's because Canada offers some real unique opportunities going forward. First, Canadian natural gas, of course, AECO locally trades at a steep discount to Henry Hub, and that's already cheaper than European or Asian prices. Producers with large gas exposure have huge optionality if Canadian LNG exports ramp up. That's one. And number two is if Canadian pipeline exposure to the US ramps up, it helps oil and helps gas. And with the recent Canadian government shift towards being more favorable to the oil and gas sector, I hope that plays out. Second, you'll see, let's say, Petrobras here, one of the fastest growing energy companies today, with Brazil emerging as a major global producer. We also have, so that's Brazilian, we have Canadian, right? So we have also Norway. So the Norwegian operator is known for extremely efficient operations and a very stable regulatory environment, even though taxes are high, so like 78%. Of course, you have deductions, but effective 50% plus. And then we have the big international players like Shell, Total, and of course Chevron from the US, which continue to be very well-run companies overall. For all these companies, we are comparing them using a couple KPIs. So I want to look at valuation, profitability, their depth, their reserve lives, and their production mix of oil and gas. So let's jump into it. First, why do we even look at oil and gas? So today we hear many bearish news on IEA's 4 million barrel 2026 supply glut on crude. But let's just look at the big picture. So hydrocarbons continue to dominate 85% of the world's energy consumption. Natural gas, especially, you have 2.2 compounded annual growth rate since 2000, and it's a large chunk, like 25%-ish of the total energy mix. Renewables are from a smaller base, and they kind of slowly growing, but you have this political shift and then corporate shift from BP to Norway to everybody else to getting more of an economic reality. And then you have, of course, AI driving cold hard fact demand. So we cannot play around with these sort of energies. We need strong baseload energy sources. So maybe in after these videos, I'm going to look at coal and nuclear because of that. So strong baseload demand. And of course, you have the trend of global GDP and energy consumption rising together. So projections suggest if you have growth, you will have energy growth as well. And of course, emerging markets, as you live better, you want to drive a car, use more electricity. So that's your backdrop. Okay, so let's look first at the oil and gas mix these companies have before comparing them directly. So it's important to recognize that oil and gas producers are not all the same. Their shares price react very differently to commodity movements simply because their production mixes are different. Right now, the market narrative is bearish on oil and bullish on natural gas, right? So that means companies with a higher gas weighting often trade at a higher valuation, while the more oil-heavy producers tend to be discounted. And you can see that dynamic clearly in the chart, on the charts following after this. Here you can see basically who are the heaviest mix on gas and oil. Peyto is basically 90% gas, and the remaining 10% is like condensates and natural gas liquids. So it's really just gas production. But it's important to remember that narrative is the voting machine short term, right? So it drives short term pricing, but it doesn't always reflect the reality. The key as an investor is not to overpay just because the narrative is popular, right? You can have a really good company, and if it's too expensive, you overpay, it's a bad investment. So let's put it this way. So for example, in the current sentiment, say there is a 99% chance of an oil glut. The market will price oil heavy companies at a discount if that's almost guaranteed, right? So, but maybe the real probability is closer to 65%. In that case, buying a discounted oil heavy name becomes a rational decision. It's priced to be 99%, but in reality, it's only 65% chance. So if you bet, that would be a rational bet to take. So understanding a production mix helps frame why certain companies look expensive or cheap, and whether that pricing is justified by fundamentals or just by the narrative. looking at valuation metrics, and I'll take two approaches. I'll favor valuation 1. On this chart, the vertical axis shows Q3 free cash flow yield. Here you see it. It's annualized. And the horizontal axis shows the discounted cash flow upside. So this is discounted free cash flows. This is my valuation. I use company projections. We looked at the videos if you want more details. Right away, you can see that Petrobras stands out by a huge margin. It's cheapest company here, both current cash flow and an intrinsic value discounted cash flow basis. Although, of course, that comes with a higher political risk, social risk, being a state-owned company in Brazil. So the interesting part is that Petrobras also has a strong growth outlook, so that also boosts your DCF intrinsic value. Next, we have Equinor, which offers a high free cash flow yield and a solid upside on a discounted future cash flow. It's more of a stable operator, but the majority state ownership still weighs a bit on valuation. Right? It's around 67% state-owned in Norway. Then you'll see Shell, Suncor, both screening as relatively cheap on both metrics. Suncor especially benefits from being oil-weighted, right? So they are like 93% oil-weighted, with gas currently favored over oil, right? Because, and then oil-heavy players are discounted, right? Of course, I forgot to mention, but if you think about oil and gas, they are basically just sources of energy. There is an argument, not just that if you unlock more infrastructure, more gas to the US or to Europe or to Asia, so like pipelines from Canada or just like LNG globally, you will get higher prices. That's one. Two, gas is really cheap relative to oil on a BTU basis. So if you look at the British thermal unit, oil is more expensive than gas. Of course, you have different things, so you need more infrastructure for gas than oil, and it's harder to move around because of that. But if those two prices converge, maybe oil goes down and gas comes up, or they both come up at the same time, but gas comes up faster, right? So that on the valuation is reflected as being bearish oil, bullish gas. If you look at Aker BP here, it screens cheap on a discounted free cash flow basis, but not on a current free cash flow basis. That's because Aker is in a heavy investment cycle until 2027, after which capex drops sharply and free cash flow ramps up. So the market is already pricing in that future growth. That's why it's trading on a Q3 annualized basis. It's like 4%, but it has a much better upside if you discount the future. Of course, what is worth more? One bird. Basically, you could look at it this way. Maybe I should have put a picture here. Like one bird in your hand or two birds in the bushes, right? That's the story. That's the comparison here. In general, yeah, because how sure are you that you have two birds in the bush and you have one bird in your hand? That's Aker for you. They are expecting many birds in the bush compared to one in the hand now. So in general, if you look at all the cluster here, Canadian names cluster in the middle, which makes sense. They are attractively valued, but not extremely cheap. And interestingly, the gas-heavy producers like Tourmaline and Birchcliff, right? Here is Birchcliff, are not cheap on the one bird in the hand. So on the current free cash flow side, but on the discounted cash flow side, they are even expensive. So they are priced for future growth. And on my projections, I use conservative gas prices. So probably whoever priced these, like if the market is expecting higher gas prices than I expected, that's the only explanation to this. So that's that. That probably reflects, yeah, basically the bullishness of gas versus oil. So overall, this valuation snapshot sort of captures today's sentiment. Oil-heavy producers look cheaper, while gas-heavy names are getting beat up on expectations of stronger pricing ahead. Okay, valuation 2. So this is another way of looking at it. On the left axis, you will see price to free cash flow, 2018 to 2024 average, which is essentially as an average PE. So it's like a PE, but I use cash flow instead of earnings, right? So this is basically a PE for you. And at the bottom, we have a price to book as of Q3. What you will notice is that the picture is very similar, right? So Petrobras is really cheap. Now the bottom left quadrant is the cheap part. Equinor is cheap. Shell is cheap. Aker is also cheap on this metric. So they sit lower on the price to free cash flow axis, and then lower on the price to book range. Gas heavy producers, on the other hand, tend to be more expensive. So you look at Beto, you look at Tourmaline, even ARC, and then of course this is royalty. So gas heavy are more expensive, which higher multiples. The only exception being Birchcliff, right? Which is extremely gas heavy, right? It's like 80-90% gas, so it looks cheap on the price to book basis, but it's because their book value for Birchcliff, its book value could be inflated by the very large reserves they have, like 28 years of reserves, but on cash flow basis it's not actually cheap. So valuation looks split, but it's actually not. The point is, gas players, as the previous slide also showed, are more highly valued. An interesting item here is Canadian Natural, which has also massive reserves, but unlike Birchcliff, it trades at a much higher price to book. And that's a good example why I prefer generally discounted cash flow and cash flow yields rather than book value multiples. So companies use different commodity price assumptions when they write down or reevaluate their reserves. If one company books reserves at a value of $60 per oil, another uses 70, then you cannot really compare them. Still, it's useful to see a broader pattern. Oil-weighted names are generally cheaper, gas-weighted names are priced for better outlook and growth and higher prices, and in general, if you look at royalty companies like Prairie Sky or where is, oh yeah, Freehold couldn't even fit the chart, it's just so high. A Freehold usually trade at a premium because their business models carries much lower risk, so you will see royalties in the top right. Looking at the profitability metrics, so now if we had looked only at valuations earlier, you might think that Petrobras and Equinor are cheap because they are bad businesses, but that's not the case at all. When we look at profitability using on the bottom return on equity and here return on investment on an average 2018 to 2024 on a basis, they are actually among the most profitable companies in the entire group. So you have Acre here, you have Equinor, you have Petrobras, right? And they were also cheap. So this raises the question, why are highly profitable companies still cheap? The answer is mainly, let's say, for Petrobras, it's political, social, and state-owned, political, social risk, state-owned company, right? And for Equinor, it's that it's also state-owned. So those factors can suppress valuations while the underlying business is doing okay. Looking across the chart, there is also a very clear trend again. So oil-heavy name companies have been more profitable than gas-heavy names. So relatively, oil in the past 7 years did better than gas. So it makes sense that when we are looking at historical return on investment and return on equity, you will see more oil-heavy names like Suncor, like Petrobras, like Acre doing better, while heavy gas names like Birchcliff, right? It's like full gas, Payo, full gas, BP 50. Oh, BP is a separate. BP, you have BP, which is struggling with everything, so there is no surprise. But it just makes sense that gas been doing worse, so your historical snapshot will be worse profitability for gas companies. And that makes sense when you consider the Canadian natural gas prices have been weak for most of the period, and these are mostly Canadian. So one very interesting name here is Canadian Natural Resources. So if you look at CNQ on the chart here, it's a 70-30 mix of oil and gas. It has massive reserves, like 40 years, and still delivers excellent return on investment and equity. But remember that the earlier slide for valuation, CNQ had a high price to book value. Now, if they are understating their book value, meaning their reserves are carried more conservatively, that could explain why their book value is high, price to book is high, why profitability measured against that book is also high. So it's another good example why using cash-based valuation metrics like free cash flow and discounted free cash flow are more reliable in my opinion. Of course, you just want to have this context. Let's say if CNQ use the same reserve pricing assumptions and someone like Suncor, they might actually look very similar on a price to book and return on equity basis. But long story short, oil companies look more oil heavy producers look more profitable than gas heavy producers because historically oil did better in the past 7 years than gas. Okay, debt. Here we are looking at interest coverage ratio here, using full 24 data, and debt to equity on the bottom using Q3 2025. Now, as a rule of thumb, I generally want to see an interest rate coverage above 5. If you read the Intelligent Investors, there are these clear guidelines. Its interest coverage ratio is very low. So if you look at, for example, okay, so we have this, we have that, and then debt to equity is the other line here. I like to see it below 50%. So ideally, companies should fall into that top left quadrant where the balance sheet is strong and financing risk is low. Now, even though, let's say, Birchcliff is here, has low debt to equity, its interest coverage ratio is very low. And I use EBIT, so earning before interest, which makes it more speculative. But even then, you would still want to check things like their current ratio, their credit facilities, and near-term outlook to decide whether they are actually distressed. So maybe it looks bad, but that just indicates that, okay, I have to do more research on their balance sheet. However, if you look at BP, it's weak on both metrics. So they have low coverage ratio and high leverage, though that doesn't mean bankruptcy. It just shows the structural issues they have been dealing with for years. On the positive note, Chevron on here is the clear leader. Balance sheet is extremely strong, so low debt, and interest cover is covered many, many times over. Tourmaline and Prairie Sky also stand with excellent financial health here. Then you notice Equinor and Aker both have debt to equity above 50%. Then they have very high coverage ratios. So that's because in Norway's fiscal system has a 78% tax rate on oil and gas companies. Of course, you have many deductibles, so the effective is like 50-something%. But importantly, interest expense comes before taxes, which incentivizes Norwegian oil and gas companies to use more leverage, and they can comfortably handle this debt load. So they can be more levered and easily handle it, as you can see. Total is slightly more leveraged than I would like to see, but overall comfortably within a manageable range. So reserve life. So this is 2P, which means proved plus probable. Reserve life can tell you a lot about the company's future. At the bottom of the chart, you will see the long reserve lives. You see CNQ, Birchcliff, Peyto, Tourmaline, extremely long reserve lives. CNQ even exceeds 40 years. Crazy. That's mainly because oil sands and large Canadian gas basins decline very slowly. These companies don't have to rush to replace production, and that gives them incredible flexibility in planning their capital spending. So meanwhile, a company like Chevron, which is heavily weighted toward the Permian Basin, deals with much faster decline rates. That means they need to constantly reinvest to just maintain production. It also explains why Chevron bought Hess recently. They needed long reserves. Of course, they have other items also, but they just want to get more reserves. So reserve life also helps to explain future capex behavior. A royalty company like Prairie Sky has a short reserve life, so you can expect them to keep pursuing new deals, which naturally takes a bite out of free cash flow, right? So a company like Canadian Natural, on the other hand, is sitting comfortably on massive reserves and doesn't need to chase acquisitions. For Canadian gas names like Birchcliff, Peyto, Tourmaline, ARC, and even Whitecap to a degree, long reserve life is a major advantage. So it positions them perfectly for the potential unlocking of Canadian natural gas through LNG exports and expanded pipeline access to the US. On the other side, you have companies like BP. Like every bad example, you'll see BP, which destroyed huge reserve value in the Russia exit, right? It had a $25 billion write-down overnight, losing that much reserves, which was like 2/3 of their reserves. In one move explains both their weak reserve life and why their long-term production outlook has been challenging so far. Then you have companies like Petrobras, which is aggressively expanding reserves with high replacement ratios. So they are growing production, but at the same time growing reserves faster than production. That's why Petrobras' latest business plans, the latest is in end of this November, include pretty heavy capex. They need to develop what they found. Shell, however, is spending below their depletion levels. So if you would look at their DDA, so like depletion, depreciation and amortization, they are spending less in capex than their DDA. They need to develop. So that means that eventually they will need to acquire and develop reserves or ramp up investment. So they either have to do acquisitions or ramp up investment. I saw recently today on X they are doing some $3 billion deal, so I'll have to read up on that. But yeah, with oil still cheap on an inflation adjusted basis, so it's historically really cheap. An acquisition phase could actually make sense for Shell to do right now, rather than to wait when oil is pricier. So overall, reserve lives gives you optionality. If you have long life reserves, you can take your time. Investment prices are attractive. So if you think about Birchcliff, which their production stayed flat for years, and now they are preparing to grow it because they are seeing natural gas prices could rise. But they have huge reserves. Look, 35 years, crazy. So they've been patient. But if you have short reserves like Shell or BP, you are forced into a higher capex just to maintain production, which raises risks that you overpay and can hurt your business long term. Of course, these companies are heavily driven by shareholders wanting cash out, and maybe so far as I saw, if you look at Canadian management, they are more engineered type of guys who are like farm boys from Canadian prairie, and they are more business oriented engineers, less than finance guys than maybe at Shell. And the ownership structure is also different, right? So this dynamic helps explain, for the Shell example, why Shell remains relatively cheap despite being a solid company, right? So you have good return on investment, return on equity, you have a 50-50 mix with gas and oil, but still you're a bit cheaper. Possibly they will need to lay out cash to get reserves and production. One additional note maybe on Shell. Let's see if they're going to relocate to the US. There's been some noise on that. Or let's see if they buy BP. That would be a death blow. So we'll see about that. Okay, now let's look at the top 5. First, I have Petrobras. It's extremely cheap, mainly because the Brazilian political, social, and governance risk around being a state-owned company. But underneath that discount, you have a very profitable company with solid reserve lives, strong growth prospects, and some interesting optionality. Their new offshore exploration areas have geological similarities to Guyana, so even if a part of that works out, that's upside. It could be substantial. Petrobras is oil heavy today, so like 80-20, but over the time we may see some gas coming into the mix. They are trying to deal with Argentina, with their Permian Basin-like area, and they've been really efficient with increasing reserves with less capex on the offshore wells they have. Second, you have Equinor. It's also very cheap. Again, largely because it's majority state owned, like 67%, but Equinor has one of the safest balance sheets here, very strong profitability, and so, even though they have higher debt to equity because of the tax structure in Norway, they can handle more debt, and a clean 50-50 mix with oil and gas production. They also have pipeline access into Europe, which is a massive strategic advantage with the Russia being out of the picture, and more or less. And politically, Norway has recently shifted to a more energy supportive stance, which removes some political overhang from the company. Third, Canadian natural resources. CNQ isn't dirt cheap, but it's cheap enough given the quality what you get. So 40 years of reserves give them total flexibility. And with a production of 70% oil, 30% gas, they also benefit from both markets. Profitability has been excellent despite their size. We discussed the book value and valuation. Maybe they are understating their equity. The huge reserve base means they never need to scramble for acquisitions. They can grow or contract production purely based on price and profitability. Fourth is ARC Resources, which is a great way to get meaningful gas exposure without sacrificing balance sheet strength or profitability. So they are roughly 60% natural gas, having long reserve lives, and still trade at attractive valuation. So if Canadian gas unlocks through LNG and pipelines, ARC will be a major beneficiary. And last but not least, Peyto. This is a pure play gas, bull case company. Pato is about 90% natural gas. The rest is NGL, so natural gas liquids and condensate. So it's let's say it's basically gas. And while profitability has been moderate historically, given that natural gas prices dynamics, we discussed that it's been relatively weaker than oil. The company is perfectly positioned for a gas upcycle. Massive reserves, 28.5 years, low costs relative, and incredible torque to gas prices, basically. It's already up about 30% year to date. So it's the least cheap name on this list if you look at, let's say, discounted free cash flow valuation, but still you have a margin of safety. But in a bullish gas environment, it's really attractive, right? So that's basically my top 5. You have Petrobras, Equinor, Canadian Natural, Arc Resources, and Pato. A mix of deep value, strong profitability, and long-term reserves, and carefully chosen companies. Going forward, I'm trying to look for another area where I can just dive into and then look multiple companies in the same sector or industry. I'm thinking about coal, as AI demand will drive baseload power need. So you cannot really do it with solar or wind. You need something baseload, so you need gas. But the problem with gas a bit is that there are basically 3 companies making gas turbines. GE Vernova, Siemens Energy, and Mitsubishi Industries, I think. Those 3, and their backlog is 3 years, and it used to be 3 quarters. So there is a small bottleneck. You also need coal and nuclear to power this. Nuclear is slow, so it takes years to build out, right? Gas now takes maybe 3 years. And then you have coal, and then a lot of places have these backup plants where they can use oil, like in Sweden, or they can use coal. So I think the backup solution is they're just gonna use more coal. I'm gonna look at how coal works. That's my best guess. If you have a better idea, please let me know. And until next time, if you enjoyed this video, please like and subscribe, and see you then next time. I hope you enjoyed the journey of oil and gas. Cheers.